sales increased 191% for the fiscal year to represent nearly 30% of total net sales. Gross margin for the fiscal year decreased 480 basis points to 24.7% from 29.5% in 2019. SG&A expenses for the fiscal year were $1.5 billion, reflecting a decline of $408.5 million, or 21.2% versus reported SG&A in fiscal 2019. On an adjusted basis, SG&A declined $348.9 million, or 18.9% year over year. Importantly, these expenses include approximately $25 million in COVID-related safety protocol costs. As we said before, we continue to expect more than two-thirds of these reductions to be permanent, as they relate to permanent closures of stores and related labor costs associated with our dedensification strategy. We reported an operating loss of $237.8 million compared to an operating loss of $399.6 million in the prior year. Adjusted operating loss was $238 million compared to operating income of $62.3 million in the prior year. Income tax for the year was a benefit of $55.3 million, driven by the changes in tax status of certain foreign entities and the impact of certain carryback provisions of the CARES Act previously mentioned. This tax benefit compares to an income tax expense of $37.6 million in the prior year. Our effective tax rate for the year was 18.9%. Importantly, we believe these tax elections will yield between $125 and $150 million in cash tax benefit to be received early next fiscal year. On a reported basis, our net loss was $215.3 million, or a loss of $3.31 per diluted share, compared to a net loss of $470.9 million, or a loss per diluted share of $5.38 in the prior year. Our adjusted net loss was $138.8 million, or a loss of $2.14 per diluted share, compared to adjusted net income of $19.1 million, or 22 cents per diluted share in fiscal 2019. Turning to the balance sheet, at the end of the fiscal year, we had cash and restricted cash of $635 million, $121.5 million higher than the end of last year, reflecting our continued efforts to optimize working capital and overall capitalization of our balance sheet. We ended the year with total inventory of $602.5 million, a 30% reduction from prior year inventory levels of $859.7 million. As a result of our ongoing inventory management efforts, our inventory efficiency continued to improve through the fourth quarter as we realized a trailing 12-month inventory turn of 5.9 times versus 4.4 times at the end of 2019. At the end of 2020, our balance sheet and liquidity position were significantly improved versus 2019, despite the impact of the pandemic. This was the result of actions we took to strengthen our financial health in 2020, including completion of an exchange offer and consent solicitation for $216.4 million of our unsecured notes, reducing the amount due to mature in 2021. Execution of 5 sale-leaseback transactions related to office buildings and the sale of a corporate travel asset, contributing approximately $95 million towards total liquidity. And the reduction of overall debt for the year by $57 million, including the early redemption of $125 million of our remaining March 2021 notes. Additionally, as of March 15, 2021, we fully redeemed the remaining $73.2 million of 2021 notes and repaid the outstanding balance of $25 million on our ABL. Capital expenditures for the year were $60 million, at the low end of our previously provided guidance of $60 to $65 million. In fiscal 2020, cash flow from operating activities was an inflow of $123.7 million, an increase of $538.2 million compared to an outflow of $414.5 million during the same period last year. The increase was primarily due to improvements in working capital as a result of optimizing inventory and accounts payable levels through maximizing the cash conversion cycle and more efficient carrying levels of inventory. In terms of our outlook, we're optimistic about our transformation in the emerging console cycle. We recognize business risks remain elevated due to the pandemic and post-pandemic uncertainty. We are not providing specific annual sales and earnings guidance. In summary, 2020 was an unprecedented year, but we're very proud of all that we accomplished to advance our strategic priorities and enhance our financial health. We finished 2020 a stronger company and are well positioned to capitalize on the opportunities ahead of us in 2021 as we move to the next phase of our transformation. GameStop is the only retailer of scale exclusively focused on the gaming industry and adjacent categories. We have a unique opportunity to become the ultimate destination for gamers. I want to take a moment to address several changes to our leadership team. As you know, we announced in February that Jim Bell was stepping down from the CFO role with the company later this week. I want to thank him for his significant contributions to our company during the stabilization and optimization phases of our transformation, particularly his leadership in managing several $100 million in expense reductions and over $350 million in working capital generation. We also announced this week that Frank Hamlin, our Chief Customer Officer, is leaving the company, and I'm very appreciative of his leadership and efforts over the last couple of years of our transformation. Specifically, his spearheading the concept development and execution of our Tulsa project of interactive gaming stores. Finally, we are very excited to welcome Jenna Owens as our new Chief Operating Officer. We believe Jenna's extensive career in technology-led organizations, such as Amazon and Google, are another important addition to our leadership team and our future transformation initiatives. Thank you again for your support and interest in GameStop. We remain very excited about the momentum we have, the many positive changes we are making, and the talent we are attracting to GameStop, all of which we believe will deliver long-term value creation for our stakeholders.
This concludes today's conference. You may disconnect your lines at this time. Thank you for your participation. Have a wonderful evening.